Hello and welcome to the Rupeeting podcast. My name is Ayush and we have Laksh on the podcast today. And you may have noticed that it's just the two of us for right now, but we're going to do something a little different this time. So, internally amongst the team, we have picked one stock each that we think is going to do really well in 2024. And we have our own little thesis behind why we think this stock is interesting. And we've kept a bet within us to see who's going to win. So I think there's about 6, 7 of us that are going to be picking each stock and talking about all of their stocks today. Now, this is a two-way thing. We're going to have a giveaway for all our viewers right here. Either you back one stock that we mentioned during the course of this podcast and comment it below in the YouTube section, or you pick a stock of your choosing that you think will do well in 2024 and put that down in the comment section as well. And let's see who makes the most returns, and whoever does, we have a little giveaway surprise for you at the end of this year. So hopefully 2024 works for you or us, but hopefully me. And let's get started with the first stock for today, which is chosen by Laksh, and it's quite an interesting one that most of us may not have heard about. So Laksh, go ahead and tell us what the stock is and what they do.
So the stock's name is Archean Chemicals, and they are the largest producer of bromine in India. And I'm pretty sure you mustn't have heard about it because they got listed also recently. They didn't. I think 1 or 2 years ago they got listed, and they dominate the bromine manufacturing space
Right.
in India. So that
If you could just explain in like a sentence what bromine is or like what is used for, just like that.
bromine is.
Oh, you don't know that? No, we won't touch it. We'll just Google it. No, like it's okay.
I know
Yeah,
where
they're all part of the.
bromine.
Bromine is used.
Yeah, bro, oh yeah, fuck. Sorry, agrochemicals and fire retardants.
Okay.
Sorry.
So that basically a chemical that prevents things from catching fire.
Yeah, and
Okay.
agrochem also. So
Agrochemicals. Okay, great. So we know what bromine is used for, and now we know that Archean is one of the largest producers of bromine in the country, and they were
yeah,
recently listed. Okay, that's
yes.
like an intro to the company. Now tell us a little bit about what caught your eye about Archean.
So what caught my eye was basically the entire chemical sector is a bit undervalued right now.
Okay.
If you look at them, and they haven't been performing very well, which comes at a good time because and so it's undervalued, not performing very well. And what caught my eye is Archean amongst them. It is of course a industry leader, and plus there are structural tailwinds for the company, such as bromine. In Apart from India, there are only three countries that produce bromine cheaper than India. That is the USA, Israel, and Jordan. Now we all know what is happening in, like, sorry to say, but we all know what is happening.
Geopolitically, yeah.
Yeah,
It's tough
Israel and
time.
Jordan are not very this competitive in this matter. And what pushes us like a notch above US is we produce more bromine than what US produces.
Okay.
So we win against Israel and Jordan in the like distribution wise. Like we can distribute right now and they can't. And we win against
USA on
US
a volume
by
stance.
volume base. Yeah.
Got it.
So I think bro, so that played out well for the company, and
Yeah.
is what that is the thing that caught my eye, at least.
Right. Okay. Maybe tell us a little bit something about what you have noticed in terms of maybe financials, something about margins, how are they doing in that front?
So margins, okay. I'll take you step by step.
Yeah.
Like the company, at least for
Yeah.
the first 2 quarters of FY24, they
Yeah.
experienced it was a very bad experience for them because they saw a dip in their margins because their bromine business wasn't doing very well. Now again, people will be like you all must be thinking, the bromine business isn't doing well. Then why is it over here?
Yeah.
But the bromine business wasn't doing well because China is their biggest importer. Basically, we export
Okay.
to China quite a bit,
Right.
and China wasn't importing due to some issues over there, like they had inventory issues plus some certain delays. So China wasn't importing as much. Now
Okay.
the company sees that there is structural tailwind, like they are looking forward to exporting other than China. Plus, China is also picking up.
Right.
The demand of bromine in China is also picking up. So that takes us from at least FH to FY24. Further on, that
Right.
gives us a better picture for the company. And
Yeah.
along with that, the company is also is specializing in R&D, and they are
Okay.
diversifying. Like they're turn they, like they are moving towards downstream products as well, like value-added products,
Got it. Okay.
such as brominated flame retardants. So those are again,
It's like a derivative product of core
yeah,
bromine.
yes,
Got it. So not only are they doing bromine and are the largest at that, but they're creating vertically other products that are related to bromine, which are probably going to be higher margin as well.
yeah, definitely.
And
Plus,
they are better in terms of a global standpoint because while the other two countries are in a geopolitical tiff and
yeah,
US won't be able to beat India in terms of volumes, whereas China also is iffy in terms of this as well, I'm assuming. Like you mentioned something about the import
no,
reduction,
China China was importing less
but
due
now
to
it's
the
back on track.
inventory. Yeah, because they had a lot of
Got it.
inventory on
Right.
hand. So now that, like, we can see signs of that side also of the business opening up.
Sorted. And it's a fairly new company on the market. So as of
Yeah,
now, I think according to the data we have, it's rallied by about 18% since the beginning in about a year's time.
yeah,
So there still seems to be upside left to, I mean,
plenty
that's
of,
obviously up
yeah,
to
that's
the
the
research that we've
user.
done.
Huh.
Yeah.
And plus,
But what kind
the,
of valuations are you seeing for the company?
so historically, the company has been trading at 17% forward EPS or earnings,
17
but
rupees or 17.
17 times
Okay, okay, EP, P.
forward,
Okay, right.
at a multiple of 17. But now it is trading at a 10 times multiple,
Okay,
which is fair enough. Like, few ups and downs the company was seeing, but moving
right.
forward, if I feel, even if it has to go back to its mean of 17,
Yeah,
I find there's plenty of upside in the stock.
got it.
Taking a 2 to 3 year forward EPS,
Yeah,
like on the basis of a 2 or 3 year forward EPS, I see there's a lot of upside in the stock, and
yeah,
there are tailwinds and uh, things backing it as well.
got it. Interesting. I think
Yes,
Archean is something that the reader can now look out for, check out in their watch list, and see what
definitely.
this new and interesting company that Lux has introduced us to is going to be up to over the next year and whether it wins the competition that we're having internally.
Yeah, I hope. I'm hopeful it does.
Great. On to the next stock. So we're going to start with Sagar, and he has an interesting stock for us today, which is
A name that probably no one's heard of, and that doesn't even sound like a company that does what it does.
yeah.
Garden Reach Shipbuilders.
So I think we're going to go in like a three-step process. So we'll start with
Yeah.
what they do, what caught your eye, and we'll talk about the numbers. So let's start with what they do.
So Garden Reach primarily builds ships. So it's shipbuilders. They build ships. Not really ships. They do more like frigates, smaller warships. So not like those aircraft carrier type vessels, but smaller
Right.
vessels for the Indian Navy. Uh,
Okay.
it is a government-owned company. shipbuilding and defense have been sensitive sectors, and the government has been historically holding on to entities that supply to the government any equipment related to defense. So this is also one of those companies which started out as a private company. However, the government took over stake somewhere in the 60s or something, and it has been
Okay.
government controlled since then. Um,
Right.
so yeah, apart from frigates and corvettes and vessels, they also make tanks and pumps and bridges and stuff like that. So all the on deck equipment also required by ships. So not just the ship, but also stuff that goes on operationally.
Right.
Um, yeah, that's Garden Reach for you. What caught my
Okay.
eye is
Yes.
so I think we've been invested in Musgao Dock through some of our products since quite a long time, and we've seen that stock go 3x already. So clearly, the shipbuilding and the defense space first has been super exciting over the last couple of years. Within
Right.
that, I think Navy has been of more focus, given the fact that the government has been itself laying a higher allocation towards the Navy compared to Army as well as Air Force. Um, so with those factors in place, defense companies and especially shipbuilding ones have been doing extremely well. And then, of course, you have the other triggers of there's an opportunity to import, export stuff. There is opportunity to indigenize and make in India. So a lot of the orders start coming to Indian players rather than going outside of India. So the overarching theme has been the overall structural play in defense, which has been ongoing for the last couple of years and will continue for the next 5-10 years. It's not like a story that will fade out immediately. There's a lot of work to be done in terms of revamping, in terms of modernizing the fleet, in terms of just overall strengthening our borders to a larger extent. Um, that's the overarching theme, but that's also reflected in the order book for Guarded Reach. So because it deals with the government, it gets these government orders. Its current order book sort of stands at about 25,000 crore. To give you
Okay.
context, 25,000 crore is actually 10 times its annual revenue. So its annual
So does
revenue
that mean
is
we can
about.
say that we have out and about visibility for about a decade in terms of their business coming in?
Yeah, that under the assumption that the company does not grow. So if you assume that the
Right.
25,000 crores of order book is executed evenly over a period of 10 years, you will see revenue growth
Right.
being constant over the next 10 years. But that's not the case.
Right.
Right? Most of these orders, a bulk of these orders are for warships and anti-submarine vessels and frigates and stuff like that, with an
Right.
execution period which is lesser. So a bulk of this revenue is actually expected to come in before 2027 because they have to adhere to
Okay.
timelines of delivery as well.
Correct.
So if they do deliver by 2027, a bulk of this revenue, order book, it will
Right.
easily result in 30 to 40% growth for the company in terms of revenue every single
Okay.
year um, till 27. And that has already sort of started reflecting in the numbers. If you look at the quarterly numbers throughout FY23, each of the quarters the company has grown at above a 30% YOY rate.
Right.
So the traction has already started coming in. The orders are already in place. It is now only about execution and delivering and showing performance in terms of financials. So
Okay.
that's where we're at. The beauty of this company, though, this is not the only reason. I mean, this is a well-known fact, right? Everybody knows the order book is 10x. That's a published number.
Right.
The analysis comes in at a part where these guys, unlike Mazgao Dock, have been lower in terms of their capability. So they're smaller than Mazgao Dock, and in terms of capability, historically they've been a little lower in terms of the products they deliver. Not quality, but the kind of products.
Okay.
So, however, they have started upgrading themselves massively over the last couple of years. And one of the things that they did was there's a submarine called the P-17.
Okay.
So the P-17, sorry, it's a warship, not a submarine. The P-17, it's a frigate. The P-17, bulk of the orders have been given to Mazda Dock to build. Um, However, even Garden Reach has started getting orders for the P-17 now. It's got orders for the Alpha. It will get orders for the newer version later at some point as well. So
Right.
along with Mazda, even Garden Reach has started bidding for these orders whenever there's a government tender or whatever. And what essentially this means is that this upgrade in profile opens up a larger addressable market for Garden Reach. So they can now win contracts in areas that they weren't even bidding for earlier, potentially increasing the deal pipeline. So while the order
Right.
book is 25,000 crores, the deal pipeline and the potential order book they can actually generate is about 1 lakh crore, which is four times
Oh
the
wow.
which is
Current order
four
book.
times the current order book and 40 times the current revenue. So that's like
Oof.
humongous scale. So you're talking about a massive, massive opportunity which is yet to materialize. And I'm not saying the expectation is of 1 lakh crore worth of orders coming in, although the company says that it can do that. Even if
Yeah.
a fraction of it comes by, even if none of it comes by, you still got a 10x
You still have.
uh, order book based on current revenue, right?
Absolutely.
So
Correct.
that's the story of the company. That's the potential, and they're currently operating at an EBITDA margin of 6%. Um,
Okay.
However, once they start delivering and operations scale up, become more efficient, with scale, they'll also achieve higher margins, obviously. Masgao Dock operates in double digits. This one can easily, when it scales up, operate at double digits. So if you sort of
Right.
look at the numbers from an overall perspective, that hey, 30% revenue growth plus potential margin expansion from 6% to 12% or 10% or whatever, there is potential for 40-50% earnings growth all the way till 2027. And the stock for that kind of growth is trading at a 25 times 2-year forward earnings. Um, so clearly, peg of 0.5, 0.6 seems like a steal um,
Of course.
from my perspective. So hence, Garden Reach Shipbuilders.
If we had just one more question to add on to this, and you drew a lot of comparison between Garden Reach and Mazga. If you had to boil it down to like three differences, what would those three differences be, and why you would choose Garden over Mazga?
Mazgao, I would say, number one, they're already upgraded in terms of profile. They're already getting the
Right.
best they have to in terms of orders. The government has been ordering P-17s. They have been innovating. They've already reached. The product mix is already better.
Right.
Garden reach is not there yet. So I think the delta is what is important to play. If you've already backed the winner, I think a potential leader is gonna make you more money. I think
Correct.
that's the first one. Second, in terms of margin as well, Mazga is already at scale. It's already doing double-digit margins. This one is at
Right.
half that margin and can again scale up. Those two, and I think the third one would be the quantum of order book. So while the absolute amount of order book would be much higher for Mazga Dock, um, relative to its size, there's a sort of the order book looks even more bloated or even more expanded for Garden Reach.
Garden Reach.
Um, so smaller scale and movement from not being that great to being great. I think that's the
Right.
play for Garden Reach compared to Moscow.
That's interesting. At least we have another alternative shipbuilding company that probably people haven't heard of that they can consider at least to add
Yeah,
on to their watch list.
yeah.
Interesting.
And I think valuation wise, the best part is that's another point that I missed out. They're
Yeah.
sitting on so much cash on their books that the cash and investments divided by market cap as a percentage of cap is about 50%. So there is
Oh,
immense
that's
amount of
unprecedented.
safety in the
That's rare. Yeah.
very rare. So
Mm.
that's like tomorrow saying that if the company has to liquidate, at least you'll get half your money back.
Yeah.
Valuations usually the
Where
cash
for other
yields uh,
companies, that'll be what, 1/10
single digits
single
usually.
digits.
And usually we've seen that whenever companies, historically, at least in my experience, I've seen that whenever companies hit a 30% mark on their cash to market cap,
Yeah.
people often flood to buy.
Right.
And I've seen that in Bombay Stock Exchange. I've seen that in Emphasis. At least these two that I can remember right away. I've seen that in eClerks. Um,
Yeah.
yeah, so that's a trigger I usually very closely track in companies. I mean, a company can be like, I can have no business trigger and that won't go anywhere, but it also needs a business trigger. And this one clearly has those in terms of acceleration.
True. Interesting alternative defense play that possibly hasn't hit the limelight just yet. And with all the interesting numbers you've mentioned. Great.
Yes.
On to the next talk. Hello. So now we have Prasanna sir with us on the podcast, and he has also an interesting stock to talk to us about, which is, I think, again, something that most people aren't very familiar with, and is a company, I think, that people you can consider it as a hedge against crude oil in some way, which people may not have heard about. So Prasanna sir, please take it away with your company and what they do.
Yeah, hi everyone. The way markets are right now going on means everyone knows that there are many stocks which are from the leading sectors or something. They know about it, but there are certain sectors where there are affiliated companies which are connected to the sector, but people hardly know about it. One of them was Seamec. Okay, it's a small cap company, small to mid cap company, and they actually provide offshore services, and their major client is ONGC. So we came to know about this company when we were researching about the shipping companies. So there are many shipping companies which are known, but CMEC is one which is basically into offshore companies. They have 6 vessels, okay, which are five of them are dry vehicles, okay, and one is barrage. So that is accommodation barrage, and 85% of their business comes from this, and they are a subsidiary of HAL, which is like they are into underwater or undersea EPC services. Okay, so that is one factor which actually added to my point why I wanted to buy this company, because there are many projects which are going on and which are expected to be underwater, and there are very few companies that basically provide underwater EPC services, and it requires a lot of skill labor. It requires a lot of expertise, and unless and until there is a lot of experience, not many orders are awarded. So that brings us to CMEC. Yes, valuation wise, it was also seen attractive, but what makes us buy this company was that they have five vessels, okay, and 3 of them, look, in shipping industry, age of the vessel always matters. So they had an age where 3 of them were 1982 83 manufactured, and they acquired in 1993. But recently what they have acquired in 21 and 22 are the manufacture is like 2006 7 and 8. So the average age of fleet has declined, so that is one part. Now, in shipping, what happens is the average contracts are around 3 to 5 years of in their age. So the contracts is made, and the rates, the higher rates remain for 3 to 5 years. Now, most of their higher rates are expected to increase into FY24 and in FY25.
Right.
So one vessel is due in December already. We are already into December, and 2 of them will be done in the mid of 2024, and 1 or 2 in 2025. So what happened that in terms of financials, they had some legacy margin issues where the contracts were at the old rates. Now with the new rates coming in, this quarter means if we consider December quarter and FY24 last quarter, so that is going to be better than expected. Okay, so that brings us to margins. Right now they are also making, they have entered one JV, and it is going to start working in the next quarter. So even that also brings us to the newer rates and higher margins. Okay, now what happens is they are going majorly for offshore. Look, offshores is a very low margin business, but the turnaround time is very fast and volumes are good. So what they are expecting, the management, what they are expecting is like the break-even period of 3 years, which is much better than industry. Usually it takes 3 to 4 years or more than 5 years to break even whatever they have invested. So that capitalization, what they rate, we consider. So it is better than industry. So that is one part. Apart from that, what gets me into it is they are not dependent on the oil prices. What usually happens is most of the offshore vehicles, they are dependent on oil prices. So whether the drilling happens, means the exploration happens, the number of wells which are like the discoveries, so they are not dependent on that. With ONGC providing most of the business, and there is a consistency and the rates remaining for 3 to 5 years, they are not dependent on oil. So the fluctuation in oil which actually impacts others, CMAC is not affected. So that is one. So that gives me a cushion. Okay. Right. Apart from that, what is important factor is they are going to do some capex for next 1 or 2 years, and that many shipping companies are not doing right now. Okay, they are having legacy vessels which they are maintaining, and that brings down their margins. So what I'm expecting is next 2 to 3 years. Look, if I'm looking for 1 year, I don't think there will be any much movement. But as we look for 18 months to 24 months, a lot of financial improvement will be seen in this. Okay. Apart from that, yes, FY24 will be good. FY25 will be with higher base. There will be margin and improvement in terms of sales and profit around 20-22%, not more than that. But I'm expecting, yes, even that is good considered to average industry growth. Okay, so that is the second part. Now, apart from that, the last point, most important point is EPC business. Okay, not many people, because they have a joint venture which starts, and it is a parent company which is into EPC business. So everyone is considering it as a shipping company, but what I feel, we must consider it as an EPC company which will get in more revenue from FY20 to 25 onwards. When look, if if the government is looking for larger corridors which comes from UAE and that comes to India, or even the oil and gas corridors which are being considered for next 5 to 7 years, I feel this company is going to benefit it a lot. So look, right now, if I look at their EPS or something, if in FY23 they were around 13 or 14 rupees, okay, but FY24 and 25 are going to be game changers. So what I am expecting is already in 9 months, if I consider, they are around 23 or 24, and 42 rupees is what I am expecting for FY24, okay, and around 54 to 56, which is for FY25. So that gives a lot of headroom in terms of valuation part. So right now valuations may look higher, but as the EPS increases, and look, in markets usually what happens now, more than EPS growth, it is the EPS expansion that drives your share price. Right. So here EPS is also increasing, and with premium business coming in, even the PE expansion would be there. So there is a double impact of that what I am expecting. Again, don't consider it only very stringently as a shipping company or what I have stated. They have expertise, they have experience, management is good, they have some vision which they will means they have delivered in last 2 years, and they are expected to deliver in next 18 to 24 months. Yes, one worry is there, the high dependency on ONGC. But again, being from oil and gas, ONGC maybe like it may be considered as one of the reasons why it is a negative. But again, there are no order stoppages that have happened from ONGC. There is nothing which is negative that has happened for ONGC. People are expecting, yes, that over the period that EV and everything would take place, and or dependency on oil and all that will decline. But I will give you a recent example. If you know, in the sugar sector, ethanol was considered as an alternative for that. But recently, government has changed its focus. It has come back to sugar. Yeah. So oil and gas are expected to be in demand. That's not that ethanol or something else will replace it and there will be no demand for it. So oil and gas, Indian oil and gas market is still expanding, and that gives an opportunity, a lot of opportunity to players like Seamec who have a lot of expertise in that sector. So that is one part. So on valuation part, I don't think that means right now it is trading at more than 40-45 PE, something around if we consider. But then as the EPS growth happens in FY24 and 25, I feel even a 25-30 kind of P, that gives us a target of 1400 or 1500, somewhere around. That is a very what we can say conservative kind of approach. P is not the way to analyze or provide any target for this, but yes, just to put some numbers, this I am providing. Otherwise, this is not a simple shipping company. It's an EPC company which will get a lot of good orders in the future.
That's a great explanation, and hopefully it'll be of value addition, because I think not a lot of people had heard about this company until Sir brought it to our limelight and has and entered into this little competition that we're having within Rupeeting. So I hope that the reader has gained insight enough to look into the stock and take all of this, of course, as not investment advice, but just as educational information from Prasanna sir. So
Yes,
thank you, sir,
that's
for sharing this with us.
purely for the educational purpose, nothing as a
Yes,
recommendation or something. Thanks a lot.
absolutely.
Okay,
Thank you.
okay, great, Ayush. Thank you.
Okay, so now we have two more stocks to cover for people who have chosen them but weren't able to make it for the podcast. And they're two of our small case managers, Mehul and Dhiren. So I think Sagar will kick it off by taking up Mehul's stock, which is an NBFC that's made quite the splash in this space. And so go ahead and tell us what the stock is and what they do.
Interesting bit is that this was my pick for last year, uh,
Yeah,
and
which made you the
this
winner
is
for
what,
last year's competition.
yes, it's propelled me to victory last year. And so clearly, if Mehul's picking it up and he has the confidence of this going up even in this year, uh,
Right.
then the story is far from over. Um, so yeah, Satin's story is pretty simple. It's been an NBFC, um, not an NBFC, a microfinance institution. It's been a MFI. So these are loans that are below rupees 1 lakh, 5 lakh, so smaller ticket size loans, provided primarily to people who are in unbanked regions. So they may be villagers, farmers, cattle, cattle herders,
Rares?
herders, okay, cattle folks, peasants. Not a nice word to use. Okay, so all of these guys,
Yeah,
whenever they want loans and they don't have a bank in the village, the ideal resort for them has been money lenders. Um, and money lenders are known to exploit people, and you've seen Lagan, so that's how their behavior is.
yeah,
However, these institutions which are governed by the RBI come into the picture to provide financing options for these guys who don't have access. Loan sizes can be as low as 500 bucks, 1,000 bucks, and can go up to a lakh or whatever.
right.
So this is the primary business of Satin. And being in this business, there is a large opportunity, but it also comes with a lot of troubles. And since 2015, it has been going through a lot of these troubles because of the floods in Assam and other regions, because of demonetization, because of COVID. So this strata of the society is usually the most vulnerable and gets affected the most whenever there's any sort of shake in the system, whether it is a natural calamity or whether it is economic in nature.
Right.
And that's why Saturn has been suffering immensely over the last few years. But it was also because of the high concentration it had towards regions which are vulnerable. So it's taken up a three-pronged approach to sort of get out of those troubles. One being diversify in terms of regions, so that you're not exposed to an Assam which floods down every single monsoon season. So
Yeah.
now that they have a more diversified presence, even if Assam has to go down every single year, the impact on business is lower compared to what it was before. So they're capping the risk in terms of exposure to geographies. The second thing they're doing is they're also expanding in terms of not just focusing on the MFI business, but also expanding into affordable housing. So affordable housing is also great as an opportunity. You've got a lot of companies in that market doing really well. And these guys are also stepping into that now very aggressively. And the third business is they're also starting to provide loans to MSMEs. So it's not only retail clients that they'll have, but they'll also have businesses which are small in nature
Right.
as clients. So that diversification will lead to a change in composition. And that's already happening. Their exposure to MFI is much lower compared to before.
Yeah.
And they have been growing their exposure to MSMEs and housing finance. These two put together have been growing at 60-70% and will continue to do so for the next 5 years. So what will happen is right now the MFI business is about 87% of total book. However, that will keep shrinking, and the MSME and SMI business will constitute to about 25% of the overall book in the next 3 to 4 years.
Right.
So you'll have a much better portfolio. And essentially, this story has already started playing out well in terms of a cleanup in the book. So a lot of the problems they had in terms of defaults have been taken care of. They've been getting either um, reimbursements from the government, or they've just sold off their bad books. So they're starting on a clean slate, a much cleaner book. NPAs have hence reduced, cost to income ratios have reduced, efficiency is improving. And of course, growth is very high because number one, the MFI market itself is very high growth. And secondly, the newer markets they're getting into are also pretty untapped opportunities. And on a small base, of course, they can grow much faster in those smaller untapped opportunities.
Yeah.
So overall, I think the story is pretty good in terms of growth and margins and profitability going ahead. However, the stocks valuations haven't been reflecting that. Valuations are still very, very inexpensive, given the fact that historically they've been troubled as a company, right? So investors usually look at the business as a very low quality book because it is very risky, it is very vulnerable, and it has not been great at absorbing shocks in the past. So investors are usually willing to pay very less for this kind of a business, and it's been trading at a 0.9 to 1 times book on a 1 year forward basis.
Yes.
However, obviously, as the de-risking happens in the MFI book, that itself should deserve a bit of a re-rating. And additionally, as their book grows more in affordable housing as well as MSMEs, that should additionally give it a potential re-rating. So over the next 3 to 4 years, as this composition changes and as financials improve dramatically, it being from a loss-making company earlier, becoming profitable and probably reaching industry standards, valuations could also reach industry standards. So great potential over the next 2 3 years if it continues playing out, and hopefully there won't be a national level shock like a pandemic or demonetization. Regional shocks are okay and absorbed to a larger extent, but obviously the larger risk that we're facing here, despite the story playing out, is a national or international level shock that affects everybody, and especially the marginalized community that these guys have as their key addressable market.
Yeah. Interesting story. And if, as you said, if Mehul still thinks that there's juice left in it, even after you've fairly extracted a bit of it last year, then the story. Were you lagging or am I lagging? Okay.
You're
We're
lagging.
back.
Yeah.
Okay. So I will be representing, or rather speaking on behalf of Dhirend's stock that he's chosen for this year, which is Xpro India. So they
Xpro is also
basically
one of
make,
our favorites. It's been in a
in the
couple of
portfolio.
portfolios for a very long time. And
Yeah,
this also, like Satin, is not a short-term story, right? It's like a slightly long-term
exactly.
delta or change playing out in the narrative of the company, and that reflecting in financials and
Correct.
valuations. So what does Xpro do?
Absolutely.
Let's start with that.
So Xpro, they make a lot of packaging material and plastic related products, but they make two major products in their arsenal. One is something known as dielectric films, which is a product that goes into anything from your screen displays to solar cells to camera lenses to sensors to even now in electric vehicles. So it's got a very all pervasive approach in terms of where its application lies. And the second is something called co-extruded plastic, which is basically like a lining that goes into stuff like your food containers, stationery, a bike helmet, anything that is like a protective layer, but it's a very hard coating of plastic. So these are their two main product offerings, and they're market leaders in this with the amount of scale that they've achieved in terms of production, because no other competitor even parallels in terms of how much they can produce in terms of volume. That's a USP that they have behind them backing, but the thesis behind it is, and it's also surrounding the two products that we mentioned. So the first being that there was a lot of import reliance for these dielectric films because there's a lot of tech that goes into making it, and a very few number of Indian players did it, with Xpro included. But now with the whole Make in India movement and all of it pushing forward for local production, Xpro seems to be at the forefront of that. So if there was like an import reliance of 67% of all dielectric needs coming in from places like China and the US, now that market is now being diverted towards Xpro satisfying those needs. So that's definitely a tailwind that will, again, as you mentioned, show up over a much longer span, but will definitely show up.
Yeah.
Secondly, and again, another reason
But
why
sorry,
they
before
seem
that,
to, yeah.
what's the like? What's the deal with dielectric films? Like, why is that such a high growth market, or why is there such high import reliance? Why is that market sexy in itself? Firstly,
Okay, so I think there's two reasons behind that. A, because it goes into almost anything that's tech related. Like it's almost like a necessity to have that film, uh, either from a protective standpoint or from an innovation standpoint in the device that you add it in. So
so it
that
basically
sort of, yeah,
avoids the transfer of electricity or electric charge
yeah,
from one part to another.
yeah. So it
So
acts
it
like
acts
an
as an
insulator of,
insulation device,
precisely, yeah,
and hence that film is not only an insulation device. That's, I think, one of the
yeah,
reasons. The other reason is that it also has the ability to store charge for momentary periods of time.
correct, yeah,
So essentially, that also helps it then come into play when it comes to more innovative uses and not just
yeah.
insulation.
Like in electric
So
vehicles, where the
yeah,
batteries need
or
that sort of charge
batteries.
holding. Yeah.
Yeah. So
So
both of
that's
these, and
one
of course, like
reason.
electronics and the use of electronics increasing
Yeah,
exponentially, these
correct.
films will also see growth in tandem with any form of
Automatically.
electrical slash electronics growing.
Yeah,
Yeah.
absolutely. And then again comes the second bit, which is connected to this bit, that because it's such a vital component, the tech that goes behind it and the know-how behind it is fairly vast, and not a lot of people can break into this market in the first place. For example, even I think on the global scale, there's only a number of players that know to do this, and hence the import reliance that used to exist. So, but Xpro seems to have honed these skills for about 4 decades now, having perfected that technology over the years. So now that they have that bank of R&D backing this product, it's not like anyone can just come in and say, "कि अच्छा मैं भी बनाऊंगा." It's quite difficult to create this product. So
Yeah,
not
there's a
just,
lot of players doing plastic
yeah,
films, right? But
yeah,
these films have to be really tiny and really thin.
correct.
So I think that's
That's
the
what she
first part, and then
said.
and then they need to have more properties and more
Yeah,
additions and value addition. So the basic
exactly.
product itself is difficult to achieve because it's a few microns in um,
In
width.
size, yeah.
Uh,
Yeah,
yeah, and then there's added layers. So yeah.
yeah. So again, that's why that market seems to be a fairly sexy place to place money or faith in. But so I think is the extruded plastic sheet product that they have. Because again, same situation where it's difficult to make the malleable sheet that there is and have it installed in all of these different spaces, whether it's a food container or a helmet or in cars mainly. So that plus the fact that again they have managed to achieve immense scale even on this front. So
Yeah.
extruded plastic sheets have also seemed to be a high growth space. And I think even while these are the spaces that they're already existing in, there seem to be more applications with stuff like sanitary products and all that they're trying to put extruded plastic in as alternatives to maybe cloth or whatever material that they used to use as co-absorption. So they're entering new spaces, and it's not like they're restricted to these sort of automotive centric or plastic product centric spaces. So it's ever growing as a market as well. Yeah, so Xpro is pretty well placed in that front, and I think over the past 5 years, with the whole space in general picking up, while their revenue may have grown only at a modest 10% CAGR over the past 5 years, they've really upped the ante in terms of profitability, where they've gone, I think, 4x in their PAT figures over the past 5 years, which is great. So from 10 to 45 crores is not a small jump.
Yeah. Hmm. So what ahead? Will it accelerate in terms of growth, given that both these markets seem to be very high growth? Uh,
Right. Yeah, so I think even from a revenue and profitability standpoint, they seem to show acceleration because of all the reasons that we stated already. So from a 10% CAGR that we've seen in the past 5 years, we can see an 18% CAGR coming up in the next 5 years. Plus, as they achieve scale, their margins incrementally improve, which will then affect their profitability. So they're expecting, or rather, the market is expecting a 33% PAT CAGR, which is again a very quick doubling of profits within a small span of time. So that seems to be the trend even in the coming half decade. And valuations seem to be in their stead as well. Whereas even though the stock price itself has skyrocketed in the past 5 years, which again why is another reason why it's a favorite in the portfolio, they're still trading at about a 24 times 2-year forward PE. So at the high level of growth that is expected, that's still below a peg of 1 at about 0.7, 0.8. So hypothetically,
But that's
if that
also,
exceeds,
I think it also can go to a higher valuation given the fact that earnings visibility also is high, right? Because
exactly,
especially in dielectric films, they're adding capacity by about 3x.
Yeah.
And that 3x capacity addition is by the only player in India and the largest player in India who's making this.
Correct.
So the entire import substitution story is open to play, and growth is something that will follow, because if you're making it in India cheaper, similar quality, and no replaceability,
Correct.
then it's only about supply matching up with demand. And if they're
Yeah.
3xing their supply over the next 3 to 5 years, there's
The
no
demand
reason
will
why
follow.
the demand's already there. They'll start
Yeah.
catering to the demand, which will
Correct.
mean revenues will follow.
Yeah.
And with scale becoming 3x, obviously the operating efficiencies and leverage also kick in massively.
Yeah.
So that should also continue driving profit growth logically.
Yeah. And another
So,
interesting pick, I guess,
yeah.
for the viewers to either back or provide alternatives for in the comment section below.
Back.
Okay.
As in, like,
Like
the
just
winner
like bet on us. Yeah.
bet on us. Yeah.
Yeah.
Yeah. That's a
Okay.
difficult one to do, right? It's
Backing one among, I think we're going to cover about 7 stocks in the course of this
yeah, we've got at
podcast.
least 5 quality stocks within that 7.
Yes. Buyers
2
in
not quality
competition.
is for people to figure out.
If they figure that out, I think that's a better giveaway winner than we can expect.
No, but if the non-quality ones actually end up winning in 2024, that's
Yeah,
I
unfortunately,
think,
that's also a
forget the win.
possibility.
It's a big loss for me.
Yeah. Yeah, true.
Awesome.
Anyway, that's
On
the
to the next
thesis
one.
on these two. On to the next one. Okay, so we're back again, and I think we're done with everyone else's stocks except our own. But we've kept these two for the last because I think both of us are in a similar industry and we're competing against each other. Where yours is Macrotech Developers, also known as Lodha, and mine is
Yes.
Godrej Properties. So let's just make the case for each of our stocks, and then we'll leave it to the audience to see who they want to back or who they want to add on in terms of our competition for 2024. So over to you, Tanvi, where you tell us, first of all, what does Macrotech do?
Okay, so Macrotech, as you said, is a real estate development company, and currently they hold properties in 3 cities. I mean, primarily in Mumbai, its suburbs, Pune, and now just recently they ventured into Bangalore as well. And as of 23 FY23, they had 33 operating projects, and yeah, they cater to luxury, premium, mid income, and affordable segments.
Right.
Hmm.
And just for the benefit of the audience, when either of us say affordable or mid affordable range, this is 1.5 crores worth of money going into a flat.
That's the
So
housing
why don't you tell?
rate.
Yeah, that's absolutely. Unfortunately, that's the housing rate.
Yeah.
I think overall the Indian real estate industry has done exceptionally well in the past 5 years, with both our
Right.
stocks or both our companies doing exceptionally well in terms of just their
Mm.
presence and the kind of offerings they have. So you tell me what caught your eye for Macrotech.
Right. So I think, like you said, first thing would be real estate, the growing market, and that could be
Yeah,
said for both of our companies. And so basically, the estate industry, they made a 7% contribution to the Indian GDP in FY22, and this number is set to increase to 15% by FY31. So in like 10 years, it's going to rise up to 15%. And then the real industry size is expected to grow to like a $1 trillion industry. So I think both our companies are set to benefit from this increase. Now, for my company, they held like a 10% market share in Mumbai only. Like that's like a big market share that they have out of this big industry. And now they've also started to accelerate growth in Pune, where they have like a few more properties coming up every year. And now the company will venture in Bangalore. So I think that's gonna be like a good growth rate for the company, where it's also set to benefit from the industry rise and also from the already land pockets that they have in these cities already. Yeah. Secondly, would be like the housing demand. So like we can see like the rising youth. Sorry, hello. Am I
Yeah, I
lagging?
think you were lagging just yeah, you're fine. Yeah, a little bit, but I think you're fine now.
Okay.
Perfect. Go ahead.
How am I doing? Is it okay?
Yeah, go ahead. It's okay.
So, secondly, the housing demand is increasing. Like now we have the rising youth population, so many educated people, and by 2030, statistics say that 10 crore people will become home ownership capable, because per capita income will see a 2.5x growth. So there's already like this demand for people to buy their own houses. Now there's something interesting to note that in FY23, the repo rate, it was increased by 25 BP, of course, which affects the mortgage rates. But despite this, there was like still a demand for housing, because the company last year saw a 62% year-on-year growth. So that's like unprecedented, and that's really like a statistic that we should be following, because more people want their own houses, and even if the interest rates are like not rising, but still if they are higher, they would still try to have their own house. So that's there. And then thirdly, the Lola Group is now coming up with the digital infrastructure business, where they're building IT parks or shopping malls, stuff like that, which will which will give them like a annuity income. So basically, by renting out these spaces to people, they'll have this constant income flow, and the construction for that will start, which has already started last year, and they've already built one park in Mumbai, or I'm not sure about the city, but they've already built one park, and over years they're gonna build more of these, and they have a partnership with Bain Capital and Evanhoe Cambridge, the company. So together, I think it would be a really good thing for the company.
Great. So that's about macro tech developers, or LOTHA as people know more frequently. I think the main difference between your pick and my pick would be, I think, a geography, where y'all are really present in the MMR region or Mumbai, whereas
Yeah.
Godrej Properties is more prominent in locations like NCR. So while you have a 10% market share in the Mumbai and metropolitan region, we have a 7 to 9% market share in NCR and all of those allied spaces. So we're killing it in the north, and y'all are killing it in the west. But
And now
apart from
South
that,
too,
just
because
exactly, with Bangalore and everything.
yeah.
Exactly. And I think we're really competing for the Bangalore space because both our companies that we've chosen are head to head in terms of percentage market share. So it's about who gets to claim a larger piece of the pie in the South Indian market now.
So
Okay,
basically,
so
for
Godrej Properties specifically, now, yeah. No, go ahead. I think it's lagging a little. Okay, you're fine now. Tell me.
no, so one thing for the Bangalore projects that they are venturing into, so what they're gonna do is it's gonna be
Yeah,
like a joint, like a JDA strategy, joint development strategy, where they get people, like they take the land off of people and then they develop it for them. So that's like a
correct.
good I don't know if I could say this, but like a high margin business where they don't have to buy the land off of them, but they can just develop it and then
Absolutely.
make money off of it. So that would be a good strategy for Bangalore because they don't have any land pockets in Bangalore. So
Correct.
yeah.
Which is, I think, again, another interesting point that I was going to mention for the same, like another tailwind that exists for both our companies. So let me just give you a
Yeah.
brief on Godrej Properties, backed by obviously the Godrej company. And as of FY23, it was stated as the largest real estate developer just solely by the number of homes sold in that particular year. Okay. Now, in the past 5 years, if we're looking at a longer time span, as you also mentioned, Indian real estate now makes up a 7% of GDP and all of that. So the entire exuberance with the real estate market is pretty high, with housing sales hitting 6-year highs in most metropolitan cities and new project pipelines hitting 10-year highs and all of that. So in the whole span of that 5 years, Godrej themselves have also outperformed not just its peers, where they had a 56% year-on-year growth in FY23, whereas all the others had maybe a 40 to 35 range. But even
Yeah.
in terms of their own ramping up, where between FY12 and FY18, they had maybe 10 million square feet average projects sold each year. Now it's north of 20 million square feet each year, and they've crossed like a 95 to 100 million square feet sold just within the past 5 years, which is a massive, massive number.
Yeah, that's a massive number. Yeah.
Yeah. Apart from that, again, number that fact that you mentioned, which was quite apt, is a lot of these real estate players are now getting into joint ventures and development related projects, where instead of just doing it on their own and incurring all of that cost with buying the land parcel, managing the whole project from end to end. Here they acquire these land parcels, or rather just develop on top of these land parcels based on the people who have already bought it before. These could be larger or smaller developers themselves. So that's a great
Yeah.
strategy and surely will result in certain margin accretiveness. But specifically for Godrej, I think they've made it a faster switch where in FY18, in their total number of projects, most of them were owned to maybe 90% or so. But now we're seeing 60 to 75% of all of their projects being JVs or DMs, which is a development management. So
Yeah.
that switch will definitely result in Godrej being a little bit more margin accretive, whereas all your companies have already hit fairly high margins. So growth story for Godrej might be a little higher in that sense. Apart from
Could be.
that,
Yeah.
diversification, yeah, go ahead.
No, no. I was just saying, yeah, could be.
Yeah, it could be. Could be. I mean, it's all, of course, none of this is advice. We're just saying it because we've done
Yeah.
like a finite amount of research. But apart from just this kind of diversification, I think, again, what Macrotech did with digital infrastructure and all of that, we are doing with hotel partnerships. So a lot of Taj hotels are now being partnered with Godrej. And while we're also venturing in the residential real estate market in the south of India, we're doing a lot of hotel projects that are joint ventures as well. So that sort of difference in the kind of business mix that we're offering as a company now, which again will probably be higher margins, and a lot more hotels will be coming in. I think to the tune of 121 more projects coming in just from the hotel segment over the past next 5 years. That's going to be a
Yeah.
massive tailwind for Godrej specifically. And apart from that, and this is why I chose, I think I'm lagging also. Okay, wait, I'm back. So a specific reason why I chose Godrej over the other companies is a lot of these companies are known to be a little lax on their governance standpoint and a little lax in terms of financial management, whereas Godrej themselves are pretty great at managing their financials, whether that is acquiring the lowest cost of debt in the entire real estate industry, where they need to pay maybe a 6 to 7% on their cost of debt, whereas companies like DLF, Macrotech will have to pay 9 and above in terms of percentage points.
Oh,
So that really
like,
gives, yeah, that gives Godrej a little bit of a leg up. And apart from that, because they've done such a ramp up in terms of the number of projects that they've A sold and B are yet to sell, their operating cash flows are looking very good for the next 2 years. Whereas for the past 2 years, it's been on a bit of a lull because they've been using it to not just pay off debts, but the high operating costs that were just associated with ramping up projects to this extent. So while it may have been on a negative front in the last 2 years, the next 2 years seem a little more healthier on that front. So higher operating cash flow, better margins, still low cost of debt in comparison to the rest of the industry. All of this makes Godrej look like a healthier proposition from a real estate standpoint, and that obviously will play into valuations. Where right now, as we speak, the stock trades at about 2012 rupees, which gives us what, a 47 times 2 year forward P multiple. So we clearly see that there is a gap between what is valued at now and the kind of potential it exhibits over the next 2 to 3 years, with strong visibility of how many projects that they will definitely sell and the kind of financial management that they pride themselves of, plus Godrej Group backing all of it. So yeah, that's Godrej for you. I think now it's dependent on the rest of the audience who they seem to, which story they seem to like more, whether they like the presence of Lodha that's becoming pan India as well, or they like the presence of Godrej, which is also competing for the same pie. Right. That's it for the podcast for this week. And we'll definitely come back to all of you all with a new topic next week. Do put in your comments below for which stock you want to back among the five of us, or a completely new stock that you think will do exceptionally well in 2024. And you might just win the giveaway from Rupeeting. Thank you. And that's a wrap.